So, if you're relatively new to the crypto space and you want to invest in Bitcoin, what is the best investment strategy that kind of optimizes for future profits? Well, in this video, we're going to dive deep into dollar cost averaging and share with you why we think this is the best strategy for most people who are wanting to invest in Bitcoin. So, whether you're a newbie or you're just curious to hear more about this topic, then all you have to do is just keep on watching. Hi everyone, I'm Kevin from Bitcoin for Beginners. This channel is all about learning and education with no frills nor fluff. So while you're watching this video, if you like what you see, then please smash that like button, subscribe down below to follow along on this journey, and hit that notification bell as well. Let's dive right into dollar cost averaging. So when it comes to investing in Bitcoin for beginners, they're often lost and have no idea where to start when it comes to strategy, right? And just do some crazy stuff and may hurt them down the road. The question they have in their mind is how to invest to generate the most profits, because ultimately that's mostly what people care about, right? So you have to know that many beginners often enter late into a bull market when price has already gone way up and people are buzzing about it at work, their taxi drivers, their aunts and uncles, and so forth. And so they end up FOMO buying near the top, and then the price crashes heavily on them afterwards. So how do you avoid that if you do come in close to all-time highs? You must utilize a good and sound investment strategy. And in this video, we're going to make the case for dollar cost averaging as an easy and safe strategy with a great chance of profit. But before that, let's take a look at the two other strategies available. Also, before I go into that, I just want to note that this video and this research was done by our teammate Adrian. So shout out to him for making such a great article on our website and now in this video. The first strategy is lump sum buying. What does this mean? This means you buy with all of your available balance all at once with a single trade. And then you just hodl and wait to get rich, right? But the problem is that many newcomers enter near the top of the bull market, so they'll get wrecked in a sense. This strategy only works if you have perfect timing, and this means that you need to be super lucky or you are a very seasoned and expert trader. The timing is very difficult with this approach, and odds are not in your favor for this to work out. Number two is active trading. There are hundreds of trading groups and channels in the crypto world. I'm sure you've noticed some of them while just perusing crypto content. They talk about charts, about their indicators, price action, and so forth. They want you to think that trading is the best way at profits. And what that means is that you swing in your Bitcoin balance between fiat, altcoins, etc., or just day trading, which is an even shorter time frame. But if you're new, there's a high chance that you're going to lose money if you do this way. Because the statistics and history shows that 70% of traders in general, not only in the crypto world, lose money from trading. Only those with the right mentality, skills and experience, or massive amounts of capitals, like if you're a whale, will stand a chance doing this method. Everyone else is better off using another strategy. So let's move on to dollar cost averaging, what this video is all about. How does it work first and foremost? Basically, you would just buy Bitcoin for a fixed amount of fiat, USD for example, in regular intervals. Whether that be weekly, bi-weekly, monthly, and so forth. Example, buy $50 worth of Bitcoin every week forever. Because the price of Bitcoin fluctuates, the amount of Bitcoin you receive for each purchase also changes over time. So when the price goes down, the amount of Bitcoin you receive for your dollar cost averaging buy goes up, and vice versa. Here's an example. Each week, I will buy $50 worth of apples. Week 1, an apple equals $1, so I'd buy 50 apples. Week 2, an apple equals $2, so I'd buy half as much, 25 apples. Week 3, an apple drops down to 50 cents per apple, so I'd buy 100 apples. Just do the division, right? So the total spent is 3 purchases of $50 each. It's $150, but I bought 175 apples with that amount. So average purchase price is, when you do the math, 86 cents per apple. So if you can see with this DCA strategy, the average price is favorable because you were able to buy more when the price was lower. Here's some of the benefits of this DCA strategy. This blind automation of your strategy gives you a more optimal purchase price than trying to time the market. This strategy, when you think about it, is super stress-free and hassle-free compared to traders who are glued to the screens and have to make sure that they set their stop losses and make sure they get their balance out when things go south. Dollar cost averaging is simple, but it still requires discipline to do it regularly, because it's easy to skip out more and more and miss out on opportunities. Very few exchanges offer automated dollar cost averaging features. Coinbase does though. So on the other exchanges, executing it may rely heavily on your own willpower and discipline. Does it actually work is a big question you may have in your mind right now. Let's take a look at the data compared to lump sum buying. And this assumes that beginners choose these instead of active trading like swing trading or day trading. And we're going to borrow some data from Ugly Old Goat's Medium article. I'll link it below in the description. Shout out to him for doing the research and the math. And basically, it shows results from dollar cost averaging versus lump summing and two of the worst times to start. Because after all, if you start in the bottom of the bear market, the lowest price, then that's super lucky and you can't expect that to be the case. So let's assume we start at the worst time possible and see how each of these scenarios play out. And these would be the top of the bull market in 2014 and the top of the bull market in 2017. Some of you guys may remember the latter one. And the strategy for DCA is $500 worth of Bitcoin monthly. So 2014 bull market top, you can pause this and take a closer look. It might be small for your mobile phones, but on desktop you can get a good look. Basically, with dollar cost averaging, we start out at January 15th, 2014, and the same with lump sum buying, your whole amount at that date. And we show you three other amounts because remember, with dollar cost averaging, we put in $500 a month, and we show you how it's performing at the lowest of the bear market in December 2018, both portfolios, and also the most recent one, which is a snapshot on May 15th, 2019. And so starting way back then, we get decent profits even in the bear market and also really good profits recently in May 2019. Lump sum buying, we also get profits, of course, because we started way back and prices are higher now compared to before, so it just makes sense. But it's way lower compared to dollar cost averaging. Now, 2017, this was a painful time for people who got in during this time. But if they used dollar cost averaging, it wasn't that bad. Because look, when you're at the very bottom, you're down 54%. But recently in May 2019, you're already 34% in profit. On the other hand, lump sum buying, you're down 81% at the lowest point in December 2018. And you're still down in May 2019, 55%. Recovering, but still not as good as dollar cost averaging if you bought in December of 2017 when it was close to 20,000 for Bitcoin's price. So the results of the data show us that dollar cost averaging performed way better than lump sum. You can look at the data, what I told you earlier, and you'd have more raw Bitcoin accumulated as well. And also for 2017, the all-time high, and you also, like I said, perform way better. You lose less at the lowest point, and you also are in profit by now compared to lump sum buying. So what's the conclusion here? It's pretty easy to outperform lump sum buying without having to learn trading and go through charting indicators, which takes a lot of time, and also without getting lucky, which is honestly a stupid thing to rely on, right? So if you're starting near all-time high, dollar cost averaging is much safer. And I do want to note that the study is based on past data though, and there's no guarantees for this to repeat itself. But the odds are definitely in the favor of the DCA investor. Therefore, newcomers, newbies, just use DCA and take the time to get to learn other techniques and learn the fundamentals, learn the tech near the financial side, and just get used to Bitcoin's volatility. And just want to note that this video and the article behind it that Adrian wrote talks about how to enter Bitcoin and assumes that you want to hodl for long term. But there's a whole nother realm of strategy that comes to profit taking and exit strategy that's not included in this discussion that you should do more research on yourself too. So thanks everyone for watching. What did you think about this video? Do you dollar cost average yourself? Let me know down in the comments below. We'll definitely get back to you. Once again, shout out to Adrian for this great content. Let us know what you think. Follow us, subscribe, smash that like button. This is Kevin, and I'll catch you guys next time.